Well, the U.S. economy added 172,000 jobs in May. That is nearly double what economists expected. The unemployment rate held steady, 4.3%, and job openings jumped to their highest level in nearly a year. Now, despite these strong headline numbers, many Americans say they still feel financially stressed as inflation continues to outpace wage growth, and consumer sentiment sinks to a record low. Joining us now to explain this trend is Ted Thatcher, president of Bright Lake Wealth Management. Ted, good to see you. So good jobs report today. We're adding jobs. Unemployment is low. Employers are posting more job openings. So why do many Americans still feel like they're falling behind financially?
Yeah, Alicia, it's always great to be with you, and it is really interesting. The truth is we saw a real strong jobs report today. We may not have seen the actual percentage change on the unemployment rate, but the beat today was huge. And really importantly, we should also note both the April and March numbers were also revised higher. So we see a trend here. And despite that fact, of course, we do see consumer sentiment and consumer confidence come down. That confidence number around consumers, how they view effectively the economy and the jobs world, I think after today's report, the next time we see that number, it's likely to be a little bit improved. Now, on the sentiment side, that's about consumers feel about their day-to-day financial lives. And we do know, of course, because of the war in Iran, prices of gasoline have been higher. We're starting to see some of that in the headline inflation numbers. And so it doesn't surprise me that that has slipped as well. Now, we have to come back to the reality, though. Consumers can say that they're frustrated about higher gas prices, and I don't blame them at all. But we have to look at their behavior, too. And when you look at the retail sales numbers, we do see consumers still spending with those numbers this week coming in at beats, actually, believe it or not.
Okay, good. So consumers are still spending. Obviously, gas prices are hard for many people. But, wage growth is now trailing inflation for the first time in 3 years. Wages are up 3.4%. Inflation is up 3.8%. Might that be another reason why sentiment has fallen to a record low? What else is there?
Certainly, when prices go up, it makes it harder on consumers. And hopefully we see that, limited to the extension of, basically the Iran conflict. I think coming into this week, last weekend, we had some hopes we were going to get positive headlines. This week, it's been rocky. It really has been it's complicated relationship with what's going on between the U.S. and, what's going on in the war in Iran. I think the markets on the whole are positive about that eventually coming down. But at the end of the day, as long as oil prices are still above $90 a barrel, that is going to continue to put that pressure on consumers. And so the faster we can get that down, the faster we'll see that stabilize and, of course, see some relief for consumers. I think today, though, we've actually had 9 consecutive weeks of wins in the markets. This week, the 10th, we're not getting 10 out of 10. I think that if you're not careful, we'd think, oh, no, there's alarm bells here. I don't feel that way. I think really it's a commentary on what might happen now with the Fed. Interest rates were set before the Iran conflict to actually most likely come down before the end of the year. And because of the higher oil prices, because actually, ironically, because of how strong the jobs report today is, we actually see a probability of a rate increase there, potentially creating a little bit more pressure.
My goodness. Okay, I was just going to ask, since the jobs report was strong, it's good news, but on the other end, makes it less likely that the Federal Reserve will cut rates. And now you're saying that they might even raise it. I mean, people are watching this closely because they want lower mortgage rates. Maybe they want to refi, buy a first home. Credit card debt is at an all-time high, so people need to pay those down. Or just, really from higher borrowing costs in general. So you're saying there might be a rise. How big of a rise are you predicting?
Right now we see a 40% probability of a single rate increase. That would mean a 25 basis point increase. So not like some massive hike, but that's typically how it's measured. Again, the probabilities can certainly change depending on, how much inflation we see or if we do see those oil prices start to come down. But right now, a very big development. I think that's why we're seeing the market lose some valuation today. It's seeing a little bit more risk there. And so until that changes, we might see this pullback, potentially extended next week. But again, I think a little bit of a pullback is healthy after 9 consecutive weeks of wins.
Right. All right. We'll keep a close eye on it. Hopefully we have more wins. Hopefully things turn around for the average American, just, trying to afford life. Ted Thatcher, president of Bright Lake Wealth Management. Appreciate your time today.
Thank you.